I'm really not too worried about the Fed. I think what we've got it pretty much understood that the Fed's going to raise rates in December, and they're going to likely to raise rates 3 more times. So we're going to be facing higher interest rates as we move through 2019, and rates are not going to reach a level, I think, in my judgment, and I think the market knows this, that are going to be really worrisome. That's going to overwhelm the growth rate of earnings until we get to late 2019 and 2020, and that's when interest rates will become a problem. So I really can't put that at the top of the list. And I don't really want to put tariffs at the trade at the top of the list. I think we've got that pretty well understood. If we had a global trade war, quite frankly, Steve, we're talking about, instead of growth, global growth of about 3.5%, it might be as low as 2.5% too, not much more than that. So I think all of these things are fairly well understood.
So are you in the don't worry, don't worry, be happy and buy stocks camp? Is that what you're saying to me, Hugh?
Yeah, I am. And I'll tell you why I'm saying that, Steve. I'm saying that primarily because if people want to say this is a bear market that's going to be accompanied by a recession, you have to make the case for a recession. And I have a very hard time doing that now. When I look at things like leading economic indicators that have been up 28 months in a row, when I look at the quantification using the yield curve, quantification of the probability of a recession, that's 14% and rising, but that's a real low number. Until that gets to 30%, I can't worry about a recession. So if I can't make the case for a recession, I can't make the case for a bear market.
Dave, do either of these things trouble you, the Fed raising rates too far, or the sort of tariff wars or skirmishes or battles, whatever, what have you, that we're in right now?
I think there are two symptoms of a trend that the market is processing over the last 4 or 5 weeks. I would add to that a stronger dollar and obviously the path of interest rates and slower global growth. What's the common thread there? They all pose more of a challenge to earnings growth in 2019. So I think really all that's been happening is that there's a downward appraisal of earnings potential for 2019. The consensus has been for around 10% earnings growth next year after obviously a monster year for earnings this year. That's probably not attainable. Half that rate might be what a realistic expectation for earnings next year.
So why do you like stocks then, Dave? I mean, if earnings growth should be half of what most of the market is expecting, do we need a downward revision in terms of our expectations for stock market returns?
Well, I think that's what's been happening over the last 4 or 5 weeks, a sort of a level setting, building that in. But I agree with Hugh in the sense that what you're really worried about, if you're thinking about a bear market scenario, is a recession. And at a 3.7% unemployment rate, and with the Fed's inflation, key inflation number at 1.6%, and real Fed funds rate still around 0, we do not have a recession around the corner. So we're in a sort of a churn environment here, more volatility, it's uncomfortable. But we still think that over the next year, stocks are likely to outperform bonds and to be up at least a moderate amount, probably single digits.
You and Hugh agree on the likelihood of a recession. We were talking offline a few minutes ago about how hard it has been for an investor with a 60-40 portfolio of stocks and bonds. Let's say you're just indexed, okay, to make money this year with the stock market up 1% and bonds down. So, Hugh, do you think next year is going to be an easier investing environment, an easier year to make money than this year has been?
Well, as I crunch the numbers, Tyler, it says to me that the market right now, because of the decline that we've seen, has gotten to a level that's 5% under the value that I think it should be at for the current quarter. And I think the upside potential between now and the end of 2019 is about 10%. So the answer to the question is yes. I think you're going to, as Dave has suggested, make more money from stocks than you will from bonds. The return from stocks, 10%. From bonds, we're talking about 2%. So, yeah, you bet. I think you're going to have to be patient, but I think you'll make more money.
And to your point, the reset is helpful to that end, basically. We've got to leave it there, guys.
You bet.